Welcome to Breaking News to Trading Moves.
Great to be here.
We are looking at a very specific set of numbers today coming out of the enterprise software sector.
Right.
It's a singular data point, but one that gives us a clear read on how large companies are managing their checkbooks right now.
Yeah, it really does.
And we were talking about Workday.
Correct. Workday recently put out their subscription revenue guidance for fiscal 2027.
Before we get into the winners and losers here, let's just connect the dots on the actual news.
Yeah.
What specifically did Workday announce that caused the market to react?
It basically comes down to the guidance range. Workday, ticker WDAY, provided a forecast for fiscal 2027 subscription revenue.
Right.
And they set that at approximately $9.93 billion to $9.95 billion.
Which, to the average person, nearly $10 billion sounds like plenty of revenue.
Oh, it is a massive number. But in this market, it's entirely about expectations versus reality.
The consensus was higher.
Exactly. Wall Street consensus was sitting right around $10.0 billion. So the guidance came in below that mark.
And when you miss the number in software, even by a tiny margin,
Your market reacts. Shares fell sharply following that update.
the natural question for you listening is, why? Did they lose customers? Is there a product issue? What did management actually say about this lower range?
Management was actually very precise. They didn't blame the product. They just stated that large enterprise deals are taking longer to close.
The timeline is stretching out.
Exactly. And they noted specific sectors where this is the most acute: government, higher education, healthcare.
And parts of the commercial market.
Right.
Those sectors are already known for being pretty bureaucratic.
They are. But the signal here is that they're becoming even more cautious right now.
Right.
It's not that they're saying no to the software. They just aren't saying yes as quickly as investors would like.
So enterprise buyers are stretching their decision timelines. Is this just an interest rate story?
Rates are part of it, for sure. Higher rates and uncertain macro conditions make CFOs hold on to their cash longer.
Makes sense.
But there is another factor at play here regarding where the budget is actually going.
You mean the allocation between keeping the lights on versus funding new technology?
Specifically, artificial intelligence. AI investment is becoming a completely non-negotiable line item for many of these companies.
But budgets are finite.
Precisely. If a company feels immense pressure to invest in AI to stay competitive, that pressure squeezes their near-term margins.
It forces vendors of traditional software.
Like HR or finance systems.
Right. It forces them to justify their return on investment much more aggressively.
So the buyer is basically saying, I have to spend on AI, so I'm going to wait 6 months to sign that HR upgrade.
That specific behavior creates a very clear split in the market. You've got winners and losers based on where that capital is flowing.
Let's break down the winners first.
Yeah. If the money isn't going to the application layer right now, where is it finding a home?
It's moving to the foundation. The first group of winners is in AI infrastructure and hyperscalers.
The hardware argument.
It is. The logic holds that while enterprise application budgets might tighten, software vendors are still prioritizing their agentic AI roadmaps.
Because they can't afford to pause that development.
Exactly. Even if I delay my payroll software, I am not delaying the build-out of the brain that runs my future business.
That keeps demand robust for the physical infrastructure.
The hardware required for model training and inference. We're talking GPUs, networking, and data center build-outs.
So let's list the specific names in this bucket. Start with the obvious one.
You have to look at NVIDIA, ticker NVDA. They remain the primary beneficiary of this spend.
Because they provide the core compute engines.
Right.
But they aren't the only ones in the chip space.
No, Advanced Micro Devices is the other key player here, ticker AMD.
As companies look for options in supply, AMD benefits from that same non-negotiable demand.
But those chicks don't work in isolation. You have to connect them.
Which brings us to networking.
Broadcom, ticker AVGO, is critical here for the custom silicon that handles data movement.
And then you have Arista Networks.
Ticker ANET.
Why specifically Arista?
Because when you have thousands of GPUs trying to talk to each other to train a massive model, the network becomes the bottleneck.
And Arista provides the high-speed switching to prevent that.
Exactly. So the logic holds that if AI spend is protected, Arista's revenue is protected.
Okay, that covers the hardware. But not every company is building a data center from scratch.
Most are renting.
Which leads us to the hyperscalers and enterprise AI platforms.
The logic here is straightforward. If a customer delays buying a new standalone application, they often choose to standardize on the platform vendors they already use.
It's just safer.
The path of least resistance. They build their AI capabilities on their existing cloud footprints.
Meaning model hosting, data tooling, and AI services can grow for these cloud providers.
Even if the growth of seats for a SaaS product like Workday slows down.
So who are we watching in this space?
Microsoft is the first one, ticker MSFFT.
Between Azure and their integration of AI into their productivity suite, they capture that consolidated spend.
Then you have the other cloud giants. Amazon, specifically AWS, ticker AMZN.
And Alphabet, ticker GOOGL.
These companies own the platforms where the work is actually being done.
If I am a CFO and I'm nervous, I stick with Microsoft or Amazon rather than signing a new contract with a smaller vendor.
That is exactly the trend.
There's another category of winners here that might seem counterintuitive at first glance. Security.
Security, identity, and governance. This is the second major winning sector.
Why does security win when HR software loses?
It comes back to the Workday emphasis on trust and accuracy. Workday deals with highly sensitive data.
Payroll, personnel files.
Right. And as companies rush to embed AI into these workflows, the risk profile changes completely.
Because you cannot just let an AI agent run loose with your employee data.
You need guardrails. As AI becomes embedded in enterprise processes, the demand rises for security controls.
Identity management.
And data governance layers. You simply cannot deploy the AI without securing the identity of the user and the data they are accessing.
So this is another bucket of non-negotiable spend.
It is. You might delay the new interface, but you cannot delay the lock on the door.
Let's get into the tickers for this group.
CrowdStrike is a name to watch. Ticker CRWD. They focus on securing the endpoint and the workload.
Then there is Palo Alto Networks.
Ticker PANW. They take a platform approach to network security.
What about for identity specifically?
Okta. Ticker OKTA. If you are going to have AI agents acting on behalf of employees, you need to be very sure about who those employees are.
That is identity management in a nutshell.
And there is one more in this group, Zscaler, ticker ZAS.
They specialize in securing data exchange in a cloud-first environment.
Which is exactly where these AI models are living.
All right, so we have the winners clearly mapped out, the infrastructure builders, the platform owners, and the security guards.
Now we need to look at the other side of the trade.
The areas that are vulnerable based on this Workday news.
This is where we see the direct impact of what management called deal duration.
The waiting game.
Yes. The first losing sector is the broader enterprise application software market.
The logic here seems fairly self-evident. If Workday is having trouble getting signatures, their peers probably are too.
That is the read. When large enterprises take longer to sign contracts, high multiple SaaS names often take a hit.
Because their valuations are entirely based on growth.
If bookings wobble or forward revenue visibility becomes unclear, the stock price reacts.
Workday is obviously in this bucket.
Workday, ticker WDAY, is the primary example, but it affects others with similar sales cycles.
Who else fits that profile?
Salesforce is a prime example, ticker CRM.
Because they sell large, complex software suites that require executive sign-off.
If approvals are slowing down at Workday, they are likely slowing down at Salesforce.
And ServiceNow.
ServiceNow, ticker NOW. They are essential for IT workflows, but again, it's a very large budget item.
If the CFO is sitting on the checkbook, ServiceNow deals can easily get pushed to the next quarter.
Snowflake is also on this list, ticker SNOW.
They are a data cloud company.
While consumption is key for them, they still rely on large enterprise commitments.
If companies are scrutinizing their data spend or delaying migrations, Snowflake feels that friction.
Now, this leads to a secondary group of losers.
Right, because if the software isn't getting bought, it isn't getting installed.
This is the IT services and implementation partners sector. It's a very logical connection that sometimes gets overlooked.
Walk us through the relationship there.
Think about a company like Accenture, ticker ACN. A massive part of their business is helping large companies implement software.
Like Workday or Salesforce. They are the ones doing the actual work on the ground.
Correct. But if the software decision slips by 3 months, the implementation project slips by 3 months.
The revenue for the service provider just gets pushed out.
It pushes services revenue timing out by a quarter or two.
That has to be particularly noticeable in large digital transformation programs.
You cannot bill for hours on a project that hasn't started.
Who else is in this bucket besides Accenture?
EPAM systems, ticker EPAM. They do high-end software engineering, and product development.
If clients are pausing new builds, EPAM sees a slowdown.
And IBM, International Business Machines, ticker IBM,
People often think of them as legacy tech.
but they have a massive consulting business.
So if those consulting engagements are tied to software deployments that are delayed, IBM's service revenue faces headwinds.
It creates a backlog, but not immediate revenue. And in this market, investors want immediate revenue.
There is a third group of losers we need to cover today. This one touches on the size of the vendor.
The mid-cap HR, payroll, and back-office SaaS companies.
Why are they more vulnerable than the giants?
It comes down to vendor consolidation. When CFOs scrutinize spending, they look for efficiencies.
They prefer to deal with fewer vendors.
One throat to choke, as the saying goes, and one bill to pay.
They would often rather bundle services with a large incumbent than manage 50 different contracts with smaller providers.
The AI-included expectation plays a huge role here, too.
Large vendors can afford to bundle basic AI features into their existing platforms at little to no extra cost.
Just to keep the contract. That is very hard for a smaller company to compete with.
The competitive bar rises.
Smaller vendors have to prove their specific AI feature is worth a separate contract and a separate security review.
That is a high hurdle when budgets are tight.
So who are the tickers facing the squeeze? Paycom Software is one, ticker PAYC.
They operate in that HR and payroll space. Who else?
Paylocity, ticker PCTY, and Dayforce, ticker DAY.
These are solid companies.
They are, but the macro environment of consolidation and scrutiny creates a stiff headwind for them.
Okay, so we have a clear picture of the landscape. Winners in infrastructure, platforms, and security. Losers in long-cycle apps, services, and mid-cap specialists.
But the market does not stand still.
Exactly. What should investors be watching for next to see how this plays out?
There are 3 specific metrics or signals to monitor following this news.
What is the first one?
Pipeline versus closes.
Break that down for us.
Software companies love to talk about their active pipeline. That is the total value of deals they are currently negotiating.
But in this environment, a large pipeline does not guarantee revenue.
Because the deals aren't crossing the finish line. If active pipeline does not convert quickly into closed deals, the market derates these growth stocks.
So investors will be listening to earnings calls specifically for the conversion rate, not just the pipeline size.
Exactly. The second signal watch is the performance of the public sector and higher education verticals.
Because Workday specifically called them out as pain points.
Yes. These verticals already have notoriously long procurement cycles.
If we see data coming out of other companies, like government contractors or ed tech firms, suggesting further delays.
It confirms that this is a sector-wide freeze, not just a Workday issue.
And the third thing to watch.
AI monetization.
This really seems to be the big question for everyone right now.
It is. Investors are starting to separate AI spend from AI payback.
What does that mean in practice?
It means that simply spending money on GPUs is no longer enough to impress Wall Street.
Companies need to show that this spending is generating revenue.
They need to show the ROI. If a company is buying thousands of chips from NVIDIA but cannot show how that hardware translates into new sales or higher margins, the market will lose patience.
The experimentation phase is ending.
And the results phase is beginning.
To wrap this up, Workday gave us a number that was slightly below expectations. But that number tells a much larger story about enterprise behavior.
It does. It tells us that mission-critical software is not immune to economic caution.
Even if you need it, you might not buy it today.
It reflects classic enterprise behavior, fewer big bets, longer approval processes, and a much higher level of scrutiny on where every dollar goes.
And right now, the dollars that are being spent are chasing AI infrastructure and security, while traditional apps and services have to wait in line.
That is the trade-off we are seeing.
It is a complex picture, but breaking it down into these sectors helps clarify the movement. You really just have to follow the budget allocation.
Follow the money.
We have covered the tickers, the logic, and the signals to watch. As we close out, I want to remind you that this content is for informational purposes only. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Always do your own due diligence.
Thanks for listening to Breaking News to Trading Moves. We will catch you on the next one.